Welcome to our first topic on the study of tax law. Topic 1 covers income, and it's one of the fundamental topics that you really need to understand, because what we're going to do in topic 1 will carry all the way through to topic 7 when we look at the taxation of companies. In this study of tax law, it's really not a question of memorising and regurgitating something. What you're going to learn is the skill of reading, interpreting and applying legislation. Many of you will say, I'm really not interested. This is a compulsory unit. I'm only doing it because I have to. Some of you will never work in tax law in Australia. However, don't look at this unit as merely the study of tax law. If you can learn to read, interpret and apply tax law, you will be able to read, apply and interpret any legislation. So it's actually a really good general skill that you'll take with you into all aspects of your working life. Tax law is really interesting, and we all pay tax, and tax, as it has been said, is the price we pay for a civilised society. So tax law is going to affect all of you if you're living in Australia. And even if you're not going to live here, if you're going to work for businesses which do business with other companies in Australia, having a general understanding of Australian law will be a really good advantage for you. So let's look at what we're actually going to do in this topic. We're going to understand how to calculate taxable income, an important term, and net tax payable. You'll be able to decide when someone receives income, is it income or is it capital that they've received? The next most important thing is, when is that income derived? And then we'll look at what qualifies certain businesses as small business enterprises, because certain rules apply to small business enterprises. We'll look at income for individuals earning salary, wages, interest, rent and dividends, and we'll also look at individuals running a business. Later in this course we'll look at companies, trusts and partnerships, but at this stage we are only looking at individuals. So the first thing we need to do is look at the historic background to this area. And what's interesting is that there is actually the power for the states in Australia to levy income tax, and they did so until 1942. The Commonwealth also imposed income tax, and in 1942, during the Second World War, the Commonwealth took over taxing of income. It then gave the money back to the states by way of grants, and since then the states have never imposed their own income tax. If they did, they would lose the money they get from the state. We are studying two pieces of legislation. We're studying the 1936 Act, and we're also studying the 1997 Act. The 1936 Act became very unwieldy, and it was also felt that the terminology wasn't as easy to understand as it could be, and so a major rewrite was commenced in 1997, or that gave us the 1997 Act. Unfortunately, that rewrite was never finished, and what we're left with is some sections still in the 1936 Act and most of the sections we're going to cover in the 97 Act. It will be easy for you to work out which Act we're looking at. The 1936 Act had sections and letters. So, for example, we'll be looking at 159N. So when you see something like that, you know it's the 36 Act. When we're looking at the 97 Act, it's easy to know that that's where we are, because it will say, it will give a section, a number, and then a dash and another number. So when you see that dash, you'll know it's a 97 Act. In your legislation, there's usually a section on the right-hand page which will say 97 Act or 36 Act. So you should always know where you are in the legislation. The first thing that we need to cover is the interpretive provisions, and so the Act actually has definitions. In the 97 Act, those definitions are in section 995-1, and in the 36 Act, they're in section 6-1. In the 97 Act, you'll see words that have been defined have an asterisk next to them, and they're referring you back into section 995-1. Be careful when you're reading definitions, because sometimes the definition will say, for this to apply, this or this must happen, in which case you're only meeting one requirement. But some sections will say, for this to happen, you must meet this and this and this. So all three requirements must be met. So it's very important to read the whole section and see what's it saying. Is it saying, for this to apply, you need this or this? Then you only meet one. But if it says this and this and this, then of course you have to meet all two or three, whatever the section's telling you. I urge you to look at your legislation, because that makes everything make sense. Sometimes in class students say to me, but why are you saying that? Why do we have to do that? And the reason is that we have a piece of legislation that says this is what's going to happen in a particular situation. So please keep looking at your legislation. As we go through these lectures, you might want to have your legislation open for when I refer to a particular section. Section 4-1 and 4-10 are the charging provisions of the Act. Section 4-1 explains who pays tax, and it says, and so we know from there that tax is payable by individuals and also by a company. The tax is payable for each financial year. The financial year that we are studying in this unit is the year commencing on the 1st of July 2009 and finishing on the 30th of June 2010. Now, wherever you study and in whatever study period, as long as it commences in this 2010 year, this is the law that we're going to look at. In your books, it's called CY for current year. So anything that says CY relates to 1st of July 2009 to 30th of June 2010. If we're looking at the previous year, which is 2008 to 2009, that will be called the PY for the prior year, and the next year, which is the future year, 2010 to 2011, we'll call FY for future year. Please make sure you understand that. Remember, we are talking about a financial year, not a calendar year. So if the question says 10th of November current year, we mean 10th of November 2009. So we're looking at financial years, not a calendar year, and you must understand that from the very beginning, or it will cause you huge problems. Section 4-5 says that when they use the word you, it refers to the taxpayer. 4-10 is our financial year ending 30th of June, and then 4-10 tells us, 4-10(3) explains to us how to calculate income tax. Now at this point we're going to start with some terms, and it's really important that you use the right term in the correct spot. 4-10.3 says income tax is calculated by multiplying taxable income by the tax rate and then reducing it by tax offsets and credits. So we need to know what is taxable income. Now, as we move through, we're going to come across terms like exempt income, assessable income, and they each mean a different thing. So make sure you understand the difference between each of these terms. How do we calculate taxable income? So at this point we're sort of moving backwards. Here's our tax calculation. To get that we need taxable income. So now we need to know how do we calculate taxable income. In 4-15, taxable income is assessable income minus allowable deductions. That gives us taxable income. I always find it interesting when I mark exam papers that students create their own terminology. And so we have things like net taxable income, gross taxable income, assessable taxable income. None of those terms are correct. You pay tax on your taxable income. Things like your low income tax offset are calculated on your taxable income. If you understand that as a concept, it will make things so much easier, particularly when we go into something like topic 6, where we have beneficiaries from trusts who are getting income from a number of sources, and students do the weirdest and most wonderful things with those calculations. If you come down to the fact that it's assessable income, we put it in, we take off our deductions, and we end up with taxable income, you'll save yourself a lot of problems. So now we have our formula, assessable income minus allowable deductions to give us taxable income. Now, the way that we get to assessable income is we actually start with all income, and we'll look shortly at what do we mean by income. So we start with all income. We take out of the equation, or we exclude from our calculations, exempt income. That leaves us with assessable income. Then we take off our deductions to get our taxable income. Then we multiply it by the tax rates. Now the tax rates will be given to you in the exam. They are also in the back of your practical introduction book. So you can have a look there and you'll be given all your tax rates. You need to work with those tax rates because of course you'll be doing lots of calculations. So the more familiar you are with them, the easier it will be for you. Once you've calculated gross tax, we reduce that by offsets. Offsets are amounts which reduce tax payable. They can be things like credits. Credits are tax which has been paid elsewhere. Perhaps your employer has deducted pay-as-you-go withholding, or you have franking credits, or you've got things like a low income tax offset. These are things which reduce your tax payable. And that ends with your net tax payable. If your offsets or your some offsets or your credits exceed your tax payable, then you actually get a refund of tax. So you'll see that we start with gross income, take off exempt, gives us assessable, and then we end up with take off allowable deductions to get to taxable income, multiply by the rate, and then we get down to our net tax payable. Offsets are an artificial amount that the government decides that people should have in certain situations. The one we will be studying will be the low income tax offset. There are also things like zone offsets. If you live in very isolated parts of Australia, you get an additional amount that reduces your tax. The main one, as I say, that we're going to do will be the low income tax offset. Credits, on the other hand, are taxes that you've paid already or somewhere else. So now that we've calculated our taxable income, we've taken our assessable income, we've taken off our deductions and we've got our taxable income. We apply our tax rates. While I've got the tax rates up here, you might want to go into your practical introduction and look at the tax rates in the back of the book. You'll see that if your taxable income lies between $0 and $6,000, you pay no tax. This is $6,000 is called your tax-free threshold. What happens after that point is in stages your rate of tax goes up. So once you earn $1 over $6,000 and up to $35,000 of taxable income, you pay 15% tax. Then between 35 and 80, your rate goes up to 30%, then to 38, and then 45. What I'd like you to do now is calculate for me, so stop the presentation, and calculate for me the tax payable on $35,000. Remember, no tax on the first 6, and then 15% above 6,000. Now have a look at the next slide, which actually explains how to calculate that tax payable. So we took $35,000 of taxable income, took off our $6,000 threshold to give us $29,000, which is taxed at 15%, and that comes to $4,350. So now we know how much tax we pay on $35,000. Let's move further and see what would be the tax payable if, as you know, the rate is progressive and above 35 we're going to a rate of 30%. What would be your tax payable on $58,000? Once again, stop the presentation and have a look and do the calculation yourself. You'll see that we took $58,000 taxable income less the threshold of $35,000, so we have $23,000 that's being taxed at 30%. This gives us $6,900 plus the tax on $35,000, $4,350. So our tax on $58,000 is $11,250. And you can see higher rates of tax as we go. So this is what we call a progressive rate of tax, a progressive tax scale. As our taxable income increases, our rate of tax increases. We now have some examples here on a few calculations. Now, for example, you might like to print these slides out and do this. Here we have someone with a salary, some franked dividends, don't worry about what they are at the moment, and franking credits to give us a taxable income of 5,429. You know, of course, that the tax payable on that is nil, and later, so you might like to come back to this example when we've done a bit more in the course, work out, would there be a refund and how much is the refund? So these are the sort of calculations you'll be doing all the time. We're going to move on to another example where our income has increased. We have a salary of 10, fully franked dividends of 2,500, franking credits which we can use to reduce our tax payable of 1,071. You might like to calculate the tax payable. I can tell you now that the low income tax offset is 1,350, so you can put that in with your franking credits of 1,071 and see if you can work out what your tax payable is. There's a further example where the income is $54,000 and we've got some more franking credits. You might like to work that example as well. For the moment, you can ignore things like low income tax offset. So we've now worked out the mechanics of how do we calculate taxable income, how do we calculate tax payable. What we need to know now is we need to work out how is tax actually collected. The government needs taxes to pay for its operations. So it can't wait till the end of the year to collect tax. So one of the systems that's in place is a system called pay-as-you-go, and there are two components to it. There's pay-as-you-go withholding and pay-as-you-go instalments. Pay-as-you-go withholding applies to employees, and what happens is the employer pays a salary to an employee, and by law the employer must retain some of that money, which is the tax payable on that salary, and remit that tax to the tax office. So this is called pay-as-you-go withholding because the employer withholds it from the salary. Now you'll find that salaries are always given in the gross figure. So it might say the taxpayer's salary was $52,000, of which $8,000 was subject to pay-as-you-go withholding. You would need to include I can't remember what I said, $52,000 in the salary as income. At the end of the year, a taxpayer lodges a tax return and shows the salary, maybe other income, and then claims, and then the tax is worked out, as you now know. And then we say, well, how much tax has been withheld under pay-as-you-go withholding? And it may be that the tax payable is $10,000, $8,000 has been withheld, so there's another $2,000 to pay. On the other hand, you might do the calculations and find out that there's only $6,500 to pay, $8,000 has been withheld, so there's a refund of $1,500. Pay-as-you-go instalments applies to non-salaried people. So it can apply to an individual who's in business, it applies to an individual who's receiving investment income. It also applies to companies, and you'll need to know that when we come to topic 7. Now, what happens here is once a taxpayer's lodged his or her first tax return, the Commissioner works out a percentage of income that must be remitted each quarter to the tax office. So each quarter, the taxpayer is sent an income activity statement in which they show their assessable income, so it could be the business income, interest, dividends and so on, and that is multiplied by the given percentage from the tax office, and then the taxpayer remits that money to the tax office each quarter. It's quite a good system. It's better than the system of provisional tax that we used to have in Australia, because you only have to pay your tax if you've received any income. So, for example, you'll find there are some people who are living on investment income and they might only receive a dividend twice a year. So only in those quarters will they be paying tax. So if they receive $10,000 in dividends and the Commissioner's given them a 20% percentage, then they'll send $2,000 to the tax office. Similarly, with employees, there'll be a balancing up at the end of the year. I have an example for you now, Jessica, the legal officer, and we've got some income, some salary, and some bank interest and some deductions. Even though we haven't done deductions, you can just deduct that amount. And then we've got pay-as-you-go deductions taken from her salary. And you might like to now stop and calculate what would be her taxable income and her net tax payable, remembering that she's had pay-as-you-go withholding taken out of her salary. So our first step is to calculate assessable income. Oh, remember, income and deductions are always in whole dollars. Assessable income, salary, bank interest, we take off the deductions to get taxable income. We worked our tax in dollars and cents. Even if it's 00, always show your 00. Then we take off the pay-as-you-go instalments. And in fact, in this case, more income, more tax has been paid than needs to be paid, and there's a refund to the taxpayer. So we've set the scene, we've done all the basics that we need to know. Now we have to go back and work out what is income, because not every payment that someone receives is income. So what is income? Before we go any further, think to yourself, write down some examples of what you think would be income. It doesn't matter if you're right or wrong, it's a good exercise for you to think about what do you think is actual income. Now, when we talk about income, the things that come to mind very generally or very quickly are things like salary, wages, allowances, interest, rent, dividends, business income, pensions. But there are probably a lot more things you can think of. If you look at the Act, there is no definition of the word income. So what we have to do is we have to look at the courts to tell us what do they think is income? What do the judges think comprised income? And the judges have come up over the years with a number of characteristics. They've said, if it has these characteristics, then it's probably income. So the first thing is, income is something that you actually receive. Now, if you think about some of what you put down as income, that would cover wages, interest. You actually receive it. It's something you actually get. As opposed to simply the increase in the value of your assets from the beginning of the year to the end of the year. So you may have bought a property at the beginning of the year for 100,000 and you've sold it, you haven't sold it at the end of the year, but it's valued at 120,000. That 20,000 increase is not income. All that's happened is your assets have increased by 20% in this case, but it's not income. The next characteristic is that it's income if it's regular and periodic. Now, regular can be really regular, as in a weekly salary, or it could be regular as in twice a year. Dividends are usually paid twice a year. Interest is usually credited twice a year. So even though it's not all the time, it's still regular, it's still periodic. Now, having said that, simply because the payment is a one-off payment doesn't necessarily mean that it isn't income. The Myer Emporium case, which I will not give you anything like this in the exam, but it was an interesting case where the company assigned an interest in interest over some years to a lump sum payment. And they thought that the lump sum payment would not be income. And in fact, when it went to the court said that in fact it was income because the transaction was what they did in the ordinary course of their business, or as part of their business. So therefore it was income. So for our purposes though, as a general rule, because if it's regular, then it tends to be income. The other thing is, if you don't receive cash, if someone gives you something, it's income if it's convertible to cash. So, for example, if I do someone's tax return and that person comes to me and says, look, I can't afford to pay you, but how about if I own a chocolate shop and let me give you the equivalent in chocolate, which of course is convertible to cash because I could sell it to other people. That becomes income. So the fact that I receive X amount of chocolates is the equivalent of the cash I would have received. But if I didn't get cash, then, if it's not convertible to cash, then it's not income. Now, there was an Australian case on this many years ago where two men each owned a truck and would deliver cool drink to people's homes. The distributor said to them, if you increase your sales by a certain amount, I will give you airline tickets and hotel accommodation for 2 people for 1 week on a Pacific island. These 2 men, Mr. Cook and Mr. Sheridan, in fact increased their sales, qualified for this prize, And of course, when it was being promoted to the people who were selling the drinks, of course, a value was put on it. You know, this prize is worth $5,000. When Mr. Cook and Mr. Sheridan lodged their tax returns, the Commissioner tried to assess them on the value of the trips. They said it's not income because it's not convertible to cash. We can't take the airline tickets in and get the cash equivalent. We can't cash in the hotel accommodation. We can't sell it to someone else. The terms of the contract were that only the person and his spouse who won, only the person who won and his spouse can travel on that ticket, use that accommodation. The court said it is not convertible to cash because if they didn't want to take it, there was nothing they could do with it. They couldn't sell it to someone else. So it wasn't convertible to cash. You'll see later how the courts got around that issue. Not the courts, I'm sorry, how the Commissioner of Tax got around that issue and was able to assess those benefits. But to be income, it must be convertible to cash. Payments for personal services are income. Now, that's quite obvious that if you go to work and you work for someone and they pay you, that's income. What's interesting, of course, it covers things like tips. If you work in a restaurant and you get tips, then those tips are income. What's interesting is they very rarely show up on tax returns. However, it's a payment for personal services, and so it's income. That would cover a situation where, say, for example, a student came to me and said, "Oh, Colleen, I'm really struggling. Look, if I paid you $1,000, would you sit down with me for a whole day and, you know, we'll run through what we've done so far?" Now, it's a payment for personal services because I've tutored the person for a day and I get paid. That income is assessable income. The fact that it's not regular, it's only one of, I only ever did it once in 10 years, it doesn't matter. It's still income. So you need to look at these concepts and see where does it fit. Business income is obviously income. And if it's a return on your capital, then it's income. And that would cover things like interest, dividends and rent. So it's not getting your capital back, it's the return on your capital. So you invest your money in the bank, you get interest, that interest is income. Now, it doesn't have to be interest from a bank. It could be money that you've lent someone, a personal friend, who repays you plus interest. The interest is also income. So you need to really be familiar with those concepts, because if it doesn't fall in there, then it's not income. The next item we need to look at in relation to income is compensation. There's a general rule, and remember our course is very simple, very basic. The general rule that we look at is if you receive compensation, it's income if it replaces income. If it replaces something of a capital nature, then it's not income. So remember the rule, if it replaces income, it is income. Now, if I walk out of class and one of my students trips me, I fall over and break my leg. Obviously I can't work because I need to be moving around the classroom. So Curtin's insurers pay me compensation, which replaces my salary. So if my salary is $1,000, they're giving me $1,000. That $1,000 that's paid from the insurance company is assessable income. It is income because it's replacing my salary. So the question you're always asking, what is it replacing? Let's say this continues for 10 weeks. At the end of the 10 weeks, my leg hasn't got any better, gangrene set in, and it gets chopped off. Now, I'm very upset about this, and so I sue Curtin for the loss of my leg, and I sue for $1 million. Let's say Curtin gave, or the insurers gave me the $1 million. The question you ask is, what is the $1 million replacing? If it's replacing, in this case, it's replacing my lost leg, and therefore that is not income. So therefore, it's not income. So if I got $10,000 for 10 weeks of lost wages, that is income because it's replacing my wage, but the $1 million is not income because it's replacing my leg. Equally, if I then get paid for pain and suffering, hospital bills, it's not assessable because it's not replacing income. And finally, in this area, occasionally you put forward a claim saying so much for lost wages, so much for the lost leg, so much for this, so much for that. And the insurer turns around and says, look, what I'll do, I'll give you a smaller amount, but that covers everything. It covers your lost wages, your lost leg, your pain and suffering, and so on. Take it and go. That lump sum, undissected payment is not income because you can't separate it. You don't know what they're saying applied where. So if the insurer just says, we'll give you this one lump sum to cover everything, and they don't separate it out, it's a capital payment and it won't be income. Section 6-5 is the section which is the operative section of the Act. This is the section which includes assessable income. It includes items in your income. And here it's the section that talks about income according to ordinary concepts, which we've already looked at. Now, it says that your assessable income includes income according to ordinary concepts, which is called ordinary income. In section 10, we have statutory income. Now, the difference between income according to ordinary concepts, or ordinary income, and statutory income is statutory income are items which the Act specifically includes in income. So ordinary income is all the sorts of things we talked about before. It would be wages and salaries and interest, rent, business income. So there's no section that says those amounts are specifically included. They come in because they are income according to ordinary concepts. But then the government, of course, says, oh, look, we want to specifically tax certain other things. So what is done is you have a specific section in the Act which says we're also going to tax these amounts. So if you look at section 10, it's got your the statutory amounts of income, or the different types of statutory income. Now, what we're going to look at 15.2, which is allowances, 1570 on reimbursement of motor vehicle expenses, which is the only reimbursement that we look at. Dividends under section 44 of the 36 Act. Those are the main ones we look at, but you might like to have a look at that table just to see what else is included. So we've got income according to ordinary concepts, statutory income, and then we have certain things which are neither income nor capital, or we've got some general sort of items, so we've just got to look at what fits where. What are some of these things we're looking at here? Some things are neither income nor capital. You look at them and they're neither one nor the other. So they might have characteristics of each, but they don't fit anywhere. There are some things that, things like windfall gains, what we call windfall gains. Lottery winnings, for example, it's a windfall gain. If you buy a ticket in the lottery, in Australia we call it lotto, you buy your lotto for the weekend and you win lots of money, it's neither income nor is it capital, it's just a windfall gain. If you bet on the horses, lots of people might go and bet on the horses and they win a few dollars. Equally, they lose a few dollars. The winnings aren't income, the losses aren't deductible. So it's neither income nor capital. Gifts which aren't related to employment are neither income nor capital. So, for example, someone gives me a present, it's not income. Slightly different if someone gives me a gift because of my work and it's some sort of payment for the work that I've done, or even saying because you were so fantastic we're going to give you this gift, then it would be income. Personal transactions like housekeeping or pocket money, or those of you who may be getting an allowance from your parents, that's not income. Now, a few miscellaneous things about income. The first one is that just because the income is illegal doesn't mean it's not income. The classic case, and I think I've got a copy of it up on Blackboard, is that of La Rosa. The case actually concerned expenses, deductions, but in the process, of course, it reiterated the fact that just because the income is illegal, it's still income. Mr. La Rosa was a drug dealer, and when he was found out to be a drug dealer, the tax office assessed him on roughly, I'll just use some rough figures here, about $750,000 that he'd made selling drugs. He received the assessment, but then objected against the assessment because he said that in that time someone had come and dug up and stolen about $220,000, $225,000, which he had buried in his back garden. And he said, well, if the income is assessable, then as we look at section 8-1 in the next topic, then this is an expense in carrying on his business as a drug dealer, and therefore it should be deductible. Now, that was found to be the case, and so while he was assessed on the illegal income, he was also allowed to deduct the money which had been stolen from him. So the Commissioner doesn't care that the income is illegal, and he will still assess those payments. And that applies to people working under false names in Perth, where prostitution is illegal. The Commissioner will still go out to the brothels and make sure that the prostitutes are registered and are paying tax and having tax deducted from their wages. So the Commissioner doesn't care that the income is illegal, he's still going to tax the illegal income. Certain social security payments are assessable. Prizes and awards. Now, in your practical introduction, I've set out the ones that we're going to cover there. Prizes and awards are assessable if they relate to earning your assessable income. So some years ago, I won an award for Lecturer of the Year and received, I think, $2,000, and that amount was assessable income because it was a payment that I received because of my work. So even though it was an award, it was still assessable income. Betting and gambling, generally not assessable unless the Commissioner considers you to be in the business, and he doesn't do that very often. Now, the next important concept, and you really need to understand this because it's going to affect us again when we come to topic 3, is the difference between a receipt of income and a receipt of capital. Income, you know, we said was regular, so it's wages, dividends, things like that. A capital receipt, so the thing about income is you tend to keep getting it, or it's because you did some work and someone paid you. Remember all those characteristics we looked at earlier. But with capital tends to be a one-off receipt. Now, the interesting thing, let's look at, you buy some shares, and those shares are going to give you dividends over the time that you own the shares. Each time you receive the dividend, that is income. It's a regular payment. It's a return on your capital. When you sell the share, that is a receipt of capital. So it tends to be a one-off payment that you get. Now, let's say that you sold your business, and so obviously you're going to get a large amount of money, and the person might say, look, I can't pay you in one hit. How about I pay you at the end of each quarter for the next 4 quarters? Now, even though it's a regular payment, what you've actually sold is your asset, and therefore it's a capital payment. There was an interesting analogy in, it was actually an American case, where the judge likened capital and income to the tree and the fruit of the tree. That as long as you hold the tree, you can get the fruit. As long as you hold the share, you get the dividends. But when you sell the tree, you've lost your capital. So when you sell your share, it's a capital receipt. So I hope that helps you understand that concept. Now, this next concept is really, really important. Once you learn, obviously, salaries, assessable, interest, dividends are all income, there's not really a problem there. However, the important issue is, when did you derive the income? Because if you go back, you'll see that it says your assessable income includes income derived in that financial year. So if you didn't derive it, if you derived it in the previous year, you'll pay tax in that year. If you derived it in the future year, you'll pay tax in the future year. So what did you derive? Now, you might be sitting there thinking, oh, big deal, you know, this year, next year, who cares? But think about it. What if tax rates are going down? For those of you who may have studied this last year or may have some knowledge of tax, you'll know that last year the second highest tax rate was 40%. This year it's dropped to 38%. So if your income was above 80,000 and you had the option of getting it, or it was going to jump up to 80,000, and you had the option of getting it in the year when it was 40% or 38, you'd prefer to get it in the year that it was only going to be taxed at 38%. So if you could have got it last year, you might want to push your derivation point into this year, so it's only going to be taxed at 38%. And once again, what if next year the tax rate goes down to 30%? You would want to leave the income and have it derived next in the following year when the tax rates dropped from 38 to 30. So derivation is very important. Equally, if tax rates were going up, you would want to bring your income forward into this year and have it taxed at a much lower rate. And that actually happened many years ago now. So long ago, I can't remember the exact details. I think the company tax rate was going from 36 to 39%. And what happened was the accountants went out to their clients and said, look, bring as much income forward as you can, so you're only going to pay tax at 36% instead of next year when it's 39%. And it actually caused quite a problem because, of course, the government was budgeting on receiving all this extra income, and so much income was brought forward in that earlier year. So derivation is a really important concept. Now, derivation depends on the type of income. So salary is derived when it's received, not when the work is done. So even if you did the work, if I did the work on the 30th of June and I didn't get paid till the 7th of July, it's derived on the 7th of July when I received it, not on the 30th of June when I did the work. That sort of thing is particularly important if you suddenly get a backdated pay. Your employer might realise that you haven't been paid at the proper rate for the last 3 years, and you suddenly get, $10,000 or $20,000, and of course you get it in the current year, and what it does is it pushes you up into a higher tax bracket. Now there's an offset associated with that, but we don't do that. But you can see that what it's done is it's moved you from a lower tax rate to a higher one. Equally, it could be the position where you've worked for the whole year, you've got your salary each fortnight, and then, for example, I've decided to take annual leave and I'm going overseas, not annual leave, study leave, and I'm going overseas to study, and Curtin says, do you want to get paid everything in one hit before you go? And I say, oh, that's a good idea. And unfortunately, it all gets paid on the 30th of June. And suddenly, I've got 2 years' worth of salary in one. And I've really jumped up a couple of tax brackets there. So derivation is really important, and you can see that. So with salary, it's when you actually receive the cash, not when you did the work. Again, remember, we're keeping things very simple with property income. It's derived when it's received. So when did you get your rent? So it doesn't matter that the tenant was overdue with rent and then pays you on the 1st of July. It's on the 1st of July that you've derived the rent. Interest, usually when it's been paid to you or credited to your bank account. So as far as we've gone at that stage, that is when income is derived for non-business income. We need to look at a couple of items of statutory income. These are items which may not meet the statutory definition of ordinary income. There's a list in 10-5. The ones we're going to look at are 15-2 allowances. Things like travel allowances, dirt allowances, danger allowance, tool allowance. One of my students told me some years ago he worked in a supermarket and he worked in the freezer section, so he got a cold allowance because he had to work in a very cold environment. An allowance is an extra amount paid to compensate you either for extra expenses or for the particular conditions of your employment. Under 15.2, the allowance is assessable income. Now, some allowances have corresponding expenses and some don't. Now, the classic, of course, is a tool allowance or a travel allowance where they're paying you money because they expect that you're going to have to pay certain expenses. So you put the income in under 15.2 and you deduct the expense. But things like dirt allowances, the cold allowance, the danger allowance is just an additional sum of money paid to compensate you for some aspect of your job. It goes in as income and it's fully taxed and there are no expenses allowed against it. So 15.2 is very important. Differentiate that from a reimbursement where, for example, you go off and you buy, so for example, a tradesperson goes off and buys some tools and goes back to the employer and says, look, I've just spent $450 buying these tools, and the employer gives the person back exactly $450. Reimbursements, you don't have to declare as income and you don't get a tax deduction. With an allowance, you declare the allowance as income and whatever you spent, either more or less than the allowance, is your deduction. If you didn't spend the whole allowance, then there's an amount that you pay tax on. If you spent more than the allowance, then you've got more deduction than income. The only exclusion to that rule about reimbursements not being income is 15-70, which is cents per kilometre reimbursement for car travel. In some organisations, your employer will say, okay, you keep a total of your mileage, and at the end of the week we'll pay you so many cents per kilometre travelled. Only in that case is the reimbursement income, and then you would use the specific sections which allow a deduction. For our purposes, if I gave you a 15-7 question, I would also give you a very easily worked out way of calculating the deductions because we're not doing substantiation of expenses. You'll see in this next slide that I've actually gone into a bit of a discussion about allowances and reimbursements. And again, you'll see the exclusion for 15.7. Dividends are specifically included in income under Section 44, and it's dividends from all sources, whether from within or outside of Australia. Now, I'm going to explain to you the issue of franking credits that sit with dividends. I will explain it. If you don't understand it, don't worry about it. Just include the franking credits. When we do topic 7, it will probably make more sense to you. Just to give you a brief history, Australia now has a system of dividend imputation. Before that, what happened was a company would run its business, make its profit, pay tax, and then its after-tax income would be distributed by way of dividend to its shareholder, and the shareholder would then pay tax on that dividend at whatever his or her rate of tax was. The problem with that, if you'd like to just write down these few figures, back in those days the top tax rate was about 62%. So if the company made a profit of $100, it paid $62 in tax. Then of the ignore all that. The company paid tax in those days at 49%. So it had $51 left. And then it paid that $51 to the shareholder, who in those days was paying tax of about 62%. So the shareholder would pay tax of about $30 odd dollars, and in the end there was something like $22 of the $100 profit that got out to the hands of the shareholder. So you can see people would think, oh, why buy shares? You know, so much of it goes in tax. So we now have the system of dividend imputation, and what dividend imputation does, the tax rate for a company is now dropped to 30%. What it's now done is it's taken the tax paid by the company, the 30%, $30 on that $100 dividend, and it imputes it to the shareholder. So it assumes that the shareholder has paid that. So what happens is, if you look at the example now, it's $100 profit, $30 tax, $70 after tax left. When that $70 goes to the shareholder is also imputed with the tax paid by the company, $30, so the dividend is now $100. The shareholder pays tax on that $100 at whatever the rate is, so if they're at 15, 30, 38 or 45, and then gets a credit for the $30 tax paid by the company. In this way, if the taxpayer is on 15 or 30%, the dividend is tax-free, or in fact can result in a refund to the shareholder. And if the taxpayer is on 38 or 45, then the taxpayer is only paying the difference. So we need a section in the Act that says not only will you include the cash dividend, but you will also include the franking credits. Now the question will be very specific and say the dividend is X and it's attached to it are these franking credits. So you must include the two figures. So here's an example. The company's got a profit of 100, pays tax of 30. There's the 70 after tax. So the cash dividend is 70, the franking credits are 30, and the shareholder has to pay tax on $100 of assessable income. There's a $30 credit, so then you work out the tax payable and you simply take off the $30 as an offset. Here's another example. On 1st of July, X company declares a dividend of $700 in favour of Mrs. Smith. It says there are franking credits attached of $300. So how much does Mrs. Smith include in her assessable income? Stop this video and work out what would be included in her assessable income. You should have worked out that she would include $1,000, the $700 cash dividend and the $300 franking credits. Now, I've put up on the web page a copy of a dividend statement for you to have a look at, and you'll see there's the amount, the cash amount, and that's the amount that was deposited into the bank account, and then there are the franking credits. So if you were filling out that tax return, you would show franked dividends and the franking credits. I'm also going to put up for you a copy of a tax return that you can actually download it from the tax office website, and you can see in the section for dividends there's the dividends, the unfranked dividends and the franking credits. Don't worry about unfranked dividends, it just means they have no credits associated with them. They're simply assessable under section 44. If we now look at the fact that Mrs. Smith has got other income of $49,000, we'll see that she shows her other income, her cash dividend, her franking credits. She's got taxable income of $50,000. We work out the tax payable and we reduce it by the franking credits. So franked dividends are really nice because the company has already paid some of your tax for you. And if you're on 15% and you haven't got any other, you haven't got a lot of other tax to pay, you can either use the differential to pay the tax on your other income, or you may even end up with a refund. And I've done that as an example for you with Mr. Jones and his dividends and his franking credits. He's got a personal tax offset which is not refundable. He's got a low income tax offset which I've worked out for you. And you'll see here that the franking credits reduce his tax payable and he's going to get a refund. What you need to be careful about is with things like low income tax offsets which are not refundable, you would deduct them first from your tax payable. So you'll see in the next example, he didn't get a salary, so we've just got the dividends. His low income tax offset drops his tax to nil, but he doesn't get a refund there, even though it's greater than his tax payable. And his personal tax offsets are not refundable, but he gets back his franking credits. So we've now done income according to ordinary concepts, statutory income. We've also done when that income was derived. We'll look at exempt income. There are three categories. There's ordinary and statutory income of entities, which is exempt, doesn't matter what sort it is. Ordinary statutory income, which is exempt. So it's the income which is exempt. So in the previous one, it was the entity that was exempt. And then the third one, which is exempt only if in certain situations. So let's look at some of those. Exempt entities are things like charities, education, religion, science, employer organisations, local government, and so on. Then where you've got income which is exempt only if it's received by certain entities, certain Defence Force payments. Now these are the reserve forces, not the Army and the Navy, but if you're in the Army Reserve or the Navy Reserve, the payments that you get are income. Interesting story here. It used to be exempt. It was made half exempt and half assessable. Lots of people left the Army Reserve, and then the government had to go back and make it assessable again. Certain scholarships are exempt. And under welfare, maintenance payments. Now this covers the situation where a couple separate or divorce and one party has to pay the other party maintenance, or alimony is the other word you might have heard. That amount is exempt income. Now, don't just dismiss exempt income. In topic 1 we say, well, if it's exempt, it doesn't impact on us, we just leave it out. When we come to topic 2, it's going to affect you, because in topic 2 it's going to affect your carry forward losses. Just some interesting history on maintenance payments. Maintenance payments used to be exempt if they were received by a woman from her husband or previous husband or former husband. And of course, when women started holding down well-paid jobs, and in some instances the husband stayed home to look after the children, then it became the woman who had to pay the man the maintenance or the alimony. And of course, there was no section to exempt it, so they actually had to change the law to say from a spouse or former spouse. So it's just interesting history. Now, I want to talk about fringe benefits here. For a long time, we had income or we had capital. And if it was income, it was assessable. If it was capital, it wasn't. There is this category of a fringe benefit. A fringe benefit is where your employer provides you with something. It could be a computer, it could be paying your telephone bill, it could be a motor vehicle, it could be allowing you to use for some of the time a work vehicle or something like that. Any sorts of benefits, car parking, loan benefits, they might lend you money at no interest or a very low interest rate. These are all fringe benefits. They are exempt from tax. However, what you need to be aware is that the employer gets the full tax deduction. So, for example, let's say because a particular person takes after-hours phone calls at home and makes phone calls from home, the employer says to that person, look, what I'll do is I'll just pay your phone bill. You keep a record for a period of time of your business private phone calls, and what happens is, let's say for argument's sake that the phone bill for the year is $1,000 and 20% was private phone calls, the employer gets a tax deduction for the full $1,000 of the phone bill. The fringe benefit is the 20% private use, and that private use is taxed under fringe benefits legislation, not under income tax. So the employer will get a full deduction. So if a question says something like the employer provided a car for the employee, the car, depreciation and running costs and everything came to $5,000, and the employee used the car 10% for private purposes, the employer gets the full $5,000 tax deduction. Under fringe benefits tax, the employer will pay tax on the 10% private use. But remember, it's not income of the employee, it's fully deductible to the employer, and then the private element is picked up under fringe benefits tax. That's very important to remember. Once we get to topic 5 and start doing reconciliations, you really need to understand that, because if it's the provision of a fringe benefit, it's fully deductible and you make no adjustment in the reconciliation. Now we're going to look at the low income tax offset. According to the Constitution, all taxpayers have to pay the same rate of tax. So as long as you've got income between $6,000 and $35,000, you pay 15%. Now that could be you only earn $35,000, or you could earn $1 million. That portion is taxed at 15% and then 30% and so on. So how does the government compensate people who are on low rates of income? It does it by way of a low income tax offset. Now, the way the offset works is if the taxable income is less than $30,000, the full offset of $1,350 applies. Once the taxable income exceeds $30,000, the taxpayer loses 4 cents of the rebate for each dollar above $30,000, and it finally phases out completely at $67,350. Now we've got an example here where the taxable income is $36,000, and what I'd like you to do is work out the net tax payable. So you have to work out the tax on $36,000, and then you have to work out the low income tax offset. So stop your presentation and make that calculation, and then we'll come back and look to see whether you got the right answer. Let's have a look at the answer. The tax on $36,000 is $46.50. The maximum rebate is $13.50, but because the taxable income is greater, we take we have 36,000 minus 30 and multiply that by 4 cents. So that's $2.40. So we're going to lose $240 of the rebate, of the offset. So that takes our offset down to 1110 and our net tax payable to $3,540. Now that's as far as we need to go in relation to an individual who's not running a business. All those issues continue to apply because you could have someone running a business and also earning salary. But we're going to now look at business income. While we will look at, I will only give you properly operative businesses, it's a good idea to look at what is a business. So the sort of things the Commissioner looks at is, does it have a profit-making motive? Does it have repetition or regularity to the activities? Is it organised in a business-like manner? What is the size and the scale of the operations? How much capital was contributed? So that gets around someone just having an expensive hobby, something like that. But as I said, I will give you properly operative businesses. Having decided that we have a business, the next issue is, when does the business derive its income? Remember, we did derivation of individual income. Now we're going to look at derivation of business income. A trading business derives its income when it makes the sale, not when it gets the cash. So this is particularly important when a sale is made and payment is to be made in a month's time, or in some cases in a year's time. The income is derived at the point at which the sale is made, not at that later point when the cash is received. Now, you'll see on the Blackboard page, I've put a couple of examples up there. One is, come in and buy some white goods and pay nothing for, I think, 6 months or 12 months. So if someone bought those goods on the 1st of June and didn't pay till the 1st of December, which is in the next financial year, because remember our year finishes on the 30th of June, even though the cash isn't received till December, the income is derived in the current year. One of those examples concerns the purchase of a car, and it's 50% payment up front and 50% in 2 years' time. So the sale price was $90,000, of which cash of $45,000 was received. But the car yard had derived $90,000 worth of income. So it's very important and can have huge cash flow implications, as you can imagine. Now that applies to things like shops, restaurants, anything that just sells things. The example here is furniture business. Buy now, 10% deposit and pay the remainder off over 3 years. So even though only 10% has been received, the full sale price is what was derived in the current year. If there's any interest to pay on those outstanding amounts, they're only derived as they fall due. Now that was where we look at making the sale and then getting the payment at a later time. Now we're going to look at the reverse situation, where payment is received and then the service is provided. This particularly applies to things like, say, a gym where you sign up for 1 year's membership or 6 months membership, or you sign up for cooking classes or tennis lessons or swimming lessons. Now, if you pay and you get all your lessons within the financial year, there's no issue. The issue arises where the person providing the service gets paid cash up front and then provides the service into the next financial year. Now, where that happens, has the person derived the income? Again, we go back to the courts. And what the courts have said is that it goes back to the Arthur Murray case, where people signed up for 10 dance classes. So they might have signed up at the end of June and the classes don't start till July. So Arthur Murray had the cash in this year, but provided the lessons in the later year. The courts saw two things as being really important. One was that even though the contract said no refunds, the reality was that they did offer refunds. And the second thing was their in-house accounting. When the payments were received, instead of saying, oh, great, we've been paid, and treating it as sales made, they actually, their accounting treatment was debit bank, credit unearned income. And then at the end of the month, when 1 month's worth of classes had been provided, whether or not people turned up, they then debited unearned income and credited dancing lessons or dancing fees or whatever they called it. So within their own accounting treatment, they didn't treat it as income actually derived. So those were the two things that really worked in their favour. Of course, if you don't give a refund, you've obviously derived the income in your business because you're never going to give any of it back. Now, the next category we look at is this issue of professional and personal services. Here we're looking at people like doctors and dentists and lawyers and accountants. What the court said, these are professional people. So they're not in a trading business. They are providing a professional service. What the court said was that accountants and lawyers provide professional services, doctors and dentists provide personal services, as do barristers. Therefore, the people providing personal services who actually did the work will use cash. Everybody else will use accruals. Many years ago, there was a one-man lawyer legal firm, Mr. Furstenberg, and Mr. Furstenberg went to the commissioner and said, "Look, I'm it. I am the lawyer. I'm not a barrister, but I am a lawyer. Therefore, I should be able to use cash instead of accruals." And the courts agreed. And it was subsequently backed up with an accountant in a similar position. So unless we're looking at, say, just a one-person practice, normally for lawyers and accountants you would use accruals. For doctors and dentists you would use cash. Then lastly in this area we have the issue of deemed derivation. Deemed derivation is in section 6-5(4), and it covers the situation in which you don't actually get the cash, but it's dealt with on your behalf. The classic example here is a dividend reinvestment scheme. The company says, "We've declared a dividend to you of $1,000. Rather than you receiving the $1,000, would you like us to give you $1,000 worth of shares?" So the fact is you never got the $1,000 worth of dividends. However, because it was dealt with at your request, you said, "Yes, don't give me cash, give me shares instead," that $1,000 will still be assessable income. So be aware of deemed derivation because it can still include income even though you haven't received the income. You haven't received the cash. Now remember we talked about Mr. Cook and Mr. Sheridan? How did the Commissioner get around that? He brought in a section called 21A in the 36 Act, which said, and this is fantastic, he said, if you get something and you can't convert it into cash, then I deem that it can be converted to cash. And if it can be converted to cash, we know that it's income. So 21A says, if you get something like this, it's deemed to be income. How do we value it? We value it at its arm's length value. What would you pay an unrelated person to get that? And if, of course, you have to pay anything towards it, then that will reduce the value of the benefit. Now, students get really confused with this, but if you think about it logically, all it's trying to do is say, well, instead of getting cash, you got something. So if the cash is assessable, the value of the thing is assessable. So here's an example of the taxpayers given a custom-made bookshelf. Say that's me, and I've done someone's tax, and they said, it's a carpenter, and he says, look, I can't pay you. How about your bill is $900. How about I build you a bookshelf, and I'll show you the costing and everything. And I say, oh, look, I want this particular wood. And he says, well, if you're going to have that, it's going to cost you $1,000. So what happens is, instead of him giving me $900 of cash, which would be assessable income, he builds me a $1,000 bookshelf. Now he says, well, the bookshelf is more than your accounting fees, so I give him $100. So what we have, what is the benefit? The $1,000 bookshelf. Did I pay anything towards it? Yes, I paid $100, so that drops the value to $900. So if you think about it now, we've got $900 cash, $900 worth of benefits. The section goes on to say, if your benefits were less than $300 in total, then it's exempt. And if, of course, you could have paid for it, then you would also get, that would also further reduce the value of the benefit. The very last thing we need to look at is small business enterprises, Division 328. Now, if you fall within the definition of a small business taxpayer, the provisions apply, and you can then choose which provisions you want to apply to you. So, firstly, who qualifies? You qualify if your average annual turnover is less than 2 million and you're carrying on a business. Once you meet those requirements, you then can use the specific requirements, so this trading stock, depreciation, prepayments, and you can choose. You can say, well, I want to use this one, but I don't want to use that one. And as we go through the course, you'll see in the question I'll say they decided to use this election, they decided to use this election, but they didn't want to use that one. And so you work that out accordingly. So we finished topic 1. We now know the general definition of income. We know what is capital. We know when income is derived. We can calculate tax payable, low income tax offsets, and we understand small business enterprises. Remember, if you have any problems with this topic, send me your questions on the discussion board.